Hey everybody, welcome back to Actual Investing. I have a bit of a different video for you guys today because I'm going to be talking about my entire 25 stock portfolio and giving you my rationale behind each stock that I own and the role that the stock plays in my portfolio. If you've been around the channel for a while, you know that on the 5th of the month, I do this series called 5 on the 5th, where I talk about 5 compelling stocks on the 5th of every month. Well, today it's going to be 25 on the 5th because I'll talk about all 25 of the stocks that I actually own. So on the screen right now is my portfolio. You can see that I own 25 stocks with about 5% in cash. This is just in case any of these wonderful stocks that I like happen to drop further. I can use that cash to buy the dips. I'm also still working, and so I'm contributing money to this portfolio every single month, and I use that money to buy stocks on sale as well. This is a process that is known as dollar cost averaging. Essentially, I'm just buying more and more of these stocks over time, and I tend to buy more of the stocks that are down more and less of the stocks that are up more, so that I try to keep an equal weight. You'll see that none of these stocks makes up more than 5 or 6% of the total portfolio, so it is quite well diversified. Let's dive into my top holding right now, which is currently Starbucks, ticker SBUX. What initially attracted me to Starbucks was their brand. They have a very, very strong brand. They're a leader in premium coffee, and the stock has been beaten down lately, mostly just due to economic conditions. So Starbucks is seeing slower foot traffic in their stores. They're seeing a slowdown in their revenue growth, even though they are still continuing to open new stores. On top of that, the company does not have the best balance sheet. They do have more debt than they have assets, which means that they have a negative book value, which typically steers me away from companies. So the fact that Starbucks is my top holding is a bit interesting. And the reason that I give Starbucks a pass is because they are very, very profitable. They have great margins on their drinks and other products, and I believe they're going to be able to continue to expand worldwide, and that once these economic conditions begin to improve, Starbucks stock should bounce back really nicely. Additionally, I'm a big fan of the business model of selling something consumable. So in this case, drinks and food. It's something that people are always going to need. You're always going to need to eat. You're always going to need to eat drink. And that doesn't mean you need to go to Starbucks. But what I'm saying is that consumables have built-in demand. So let's say you go to Starbucks, you try their new latte, you like it. The next day you're thinking, oh man, I really could use another one of those lattes. You go back to Starbucks, you get another latte. Starbucks has a lot of sweet, sugary drinks, and sugar is addictive, unfortunately. So I think Starbucks really just has people in the palm of their hand. And I use this temporary weakness in the stock to add to my position. I've been building up this position for probably the last year or so, and it's slowly become my top stock, and I'm quite happy with that. We can see that even though revenues were flat in the previous quarter, year over year, they are opening new stores, which should help to fuel growth in the future. What I also like is that they're a strong dividend stock, and they've been growing their dividend at an 18% compound annual growth rate over the past 10 or so years. This chart is a bit outdated. So the role that Starbucks plays in my portfolio is as a dividend stock with a strong brand that helps me sleep well at night. My second largest position is a company called NextEra Energy, ticker NEE. NextEra Energy is a dividend aristocrat, which means they've been consistently raising their dividends for at least 25 years. You can see that in the chart on the bottom. What I like about NextEra Energy is that they're a utility company, but they also are the world's largest renewable energy company. So in the bottom left, I have a picture of one of their renewable projects where they have some wind turbines and solar panels right next to FPL, which is Florida Power, which is their quote unquote dirty energy company. So at the top left, we can see a chart. About 50% of their energy mix is natural gas. That's that light blue. But then we see another 40% is from renewable energy sources, like wind is the big one, nuclear, which is the second biggest one, and solar, which is just a sliver, but I expect that to grow. We can see that coal and oil make up about 1% of NextEra Energy's total energy mix. So I like that NextEra is kind of the best of both worlds. It's a traditional utility, but it's also a clean energy utility, and I really like that. I think that demand for clean energy is only going to continue to grow as time goes on, especially with the advancements in AI, causing more and more need for compute power. That's just going to need a lot more electricity to run, and companies like NextEra should stand to benefit in the long term. So the reason I hold NextEra is for the dividend as well as the growth potential. It's a bit of a blend stock. My third largest holding is Tesla. This actually might be my second largest holding now. It's been on a bit of a tear lately. Tesla is a stock that I like because I really do believe it's one of the most innovative companies in the world. And I know that the CEO is quite controversial, and I'm okay with that. Tesla, for me, is a play on multiple disruptive technology themes. Electric vehicles are a theme that I'm quite bullish on. I believe that as time goes on, they're just going to continue to rise in adoption. And Tesla is the leader in the US for EVs by market share. They have about a 50 to 60% market share in the US. Nothing else even really comes close to that right now. So if you want to invest in an EV manufacturer, Tesla is, in my opinion, the best bet. However, they're more than just EVs. They're also play on vehicle autonomy with their robotaxi that's supposed to be being announced next month, I think. We'll see. Elon has been known to overpromise sometimes. And they're also play on robotics. They're actually developing a humanoid robot called Optimus. They have a solar division. So to me, Tesla just checks a lot of the boxes that I'm bullish on. And the company, I believe, has had really strong execution in the past. Recently, the stock has been beaten down because vehicle deliveries actually fell for the first time year over year, but it seems we may have reached a bottom with deliveries reaccelerating quarter over quarter. So I think that's what's led to Tesla's recent run. Also, if you look at the recent news for Uber, it sounds like they're going to have to start paying their drivers a bit more. And so I think that the more expensive Uber and Lyft becomes to use, the more the demand will rise for robotaxis. Mondelez International is the next stock on my list, ticker MDLZ. This is nothing super exciting. Essentially, they are a cracker and cookie and food company. Mondelez owns a lot of very popular brands in the US and around the world. If you look at this picture on the screen right now, you can see some of their brands. Some of the ones I happen to like are Oreo, Belvita, Cliff. I happen to buy those products a lot. That's what initially drew me to the company. However, what I also like is their strong dividend growth. In this purple chart at the top, we can see their dividend has been rising steadily over time. And also, I believe that they're a very innovative food company. If you think about Oreo always coming out with new flavors, I think that speaks a lot to the ability that Mondelez has to innovate with their products and keep consumers coming back. Kind of like I said with Starbucks, I like that food kind of has built-in recurring revenues. As people eat something, they like it, they come back, they're going to continue to buy that product. That's not the only reason why I bought Mondelez. It also seems to have quite a cheap valuation right now on both the price to sales and price to earnings level. They are growing revenues still. That's beginning to slow a bit, but I just believe Mondelez to be a very solid company. They pay a nice dividend, and again, they help me sleep well at night. Next is ServiceNow, ticker NOW. ServiceNow is a bit of a complex company to understand because they are a software giant. They started out as an IT service management company. That's kind of where the name comes from, but they've sort of grown into this software conglomerate that they are today. If you look at the chart on the bottom right, you can see that the revenue growth has just been astounding and just has not let up at all despite all the different economic hardships that we've gone through in the past few years. ServiceNow actually grew their quarterly revenue over 20% year over year in this past quarter. So that's just amazing to see that ServiceNow is a giant and they're still continuing to grow. I also believe that they're a beneficiary of AI. They actually are using their own large language model in their offerings, and I believe that with all the data that they have, they can leverage this to use AI to help businesses to run more smoothly and efficiently. Aside from IT service automation, they also do things like process automation, which is similar to what a company like UiPath does. So ServiceNow, I believe, is a great growth stock that provides exposure to a lot of exciting themes like AI and automation. Ulta Beauty is the next stock on my list, ticker ULTA. This is a somewhat recent ad. Ulta, I just found a lot of value in the stock, trading at a reasonable valuation, and it's a company that has just been steadily buying back their shares over time. They've chosen not to pay a dividend and instead repurchase shares, which is kind of refreshing to see. I sort of like that. If you have a taxable account, sometimes you don't like getting dividends because you have to pay taxes on them, whereas if the company buys back shares, it bumps up the share price, which you're not taxed on until you sell. So even though I tend to hold value stocks in my Roth IRA, so the dividends are tax-free anyway, it's still really nice to see Ulta Beauty buying back shares. That just really gives investors confidence in the company in the long term. Now, you could make the argument that they shouldn't just arbitrarily buy back shares because they might be buying them back at high prices, but Ulta is kind of doing the steady approach where they buy back shares no matter what the conditions, so they're going to get the highs and the lows, and that's kind of what I do with my investing anyway, so I like to see that Ulta's management is aligned with me. Essentially, Ulta sells beauty products, but what they also offer are services. So in every Ulta store, or maybe almost every Ulta store, you can go in and get salon services. So I believe that that is going to really help them retain customers, especially because if you go in to get your hair done, you might also want to shop around and maybe buy some new makeup or buy a new shampoo product. Ulta has also been growing really steadily in both their revenues and their earnings. And even though sales growth has been slowing, it's still positive, and I like to see that. The next stock on my list is Lululemon, ticker LULU. Lululemon is an athletic wear company, and I've just found it really difficult to find a good apparel company. I'm a bit skeptical of the apparel industry only because it's very competitive and there's a lot of trends that go on in apparel. So if one thing is popular one year, say Crocs, they might be super unpopular the next year and then popular again. So I wanted to try to find something that was somewhat evergreen, and I think athletic wear is that product. Lululemon has been steadily growing over time, which I like to see, and their stock is at pretty much a 52-week low. So that doesn't necessarily equate to value, but that is kind of what drew me to the stock. I decided to see if there was value there. Essentially, you shouldn't just look at a stock price and say, oh, it's down, it must be cheap. It's more important to say, oh, it's down, I wonder if it's cheap. And that's kind of what I did with Lululemon. And indeed, I did find it cheap. So Lululemon is still growing. Essentially, what's going on is that their US sales are slowing. And again, that comes back to the economic conditions that we're seeing in the US. However, they are continuing to expand internationally. I believe Canada is their next biggest geography. And I think that's going to bode really well for the company going forward. We can see that they're continuing to open stores just like Starbucks. So I think that's going to also continue to fuel growth. They also have quite a nice balance sheet and just really solid profit margins. So Lululemon is a stock that I quite like. Next on the list is PayPal, and honestly, I've never seen a more controversial stock than PayPal. Some people think it's the cheapest thing in the world, and some people think that it's completely irrelevant and they hate it. So PayPal, yeah, I happen to be in the camp where I think it's a great value. So for me, PayPal is a stock that I believe plays on the theme of e-commerce. So I'm quite bullish on e-commerce. I think that as time goes on, it's only going to continue to grow. I think my generation, the Zillennials as they call them, is going to shop mostly online. And PayPal, I think, has carved itself out a nice little moat in that industry. However, as you can see from this picture in the top left, they also offer point-of-sale systems similar to what Square does. So if you're shopping in person, you could use PayPal as well. They're also a play on digital wallets, on crypto, and on buy now, pay later. Those are themes that I'm not quite as bullish on, but it's nice to get that incidental exposure. Even though people think PayPal is kind of a dinosaur and is no longer growing, this chart in the bottom left shows that their annual revenues are growing quite consistently. And when we look at the electronic payments market share in the bottom right, we can see that PayPal commands about a 50% market share. So to me, PayPal is a stock that has a lot of potential that I think people tend to overlook. They also own a lot of other brands, so Zettle, which is that point of sale system that I talked about earlier. They also own things like, I believe it's pronounced Xoom, Xoom, which is cross-border funds transferring, and they have Venmo, which is really popular for peer-to-peer payments. I don't think they have really monetized that very much lately, but I think that they might have some potential to squeeze out a bit of profit from that in the future. So PayPal is a nice core stock where it's growing. However, it also has a low valuation and shows characteristics of a value stock with strong profitability. Next up is Snowflake, ticker SNOW. Snowflake is a big data company. I like this chart here because it kind of talks about what Snowflake does. Essentially, they unite data sources with data consumers. So things like databases and IoT data can use their data lake, data warehouse, and data engineering platform to help consumers, in this case, companies, I know it's a bit confusing, make sense of this data. I think as time goes on, Snowflake's really going to benefit from their consumption-based pricing model. What they do is charge customers for the more that use the platform as opposed to just a flat fee. And so I think with the growth of big data will come a growth in revenue for Snowflake. They are still growing quite strongly. And even though they have a bit of a profitability problem, I think that that will be resolved in time. I think Snowflake just has a lot of potential right now. And I really am happy to get some exposure to the growth of big data, AI, machine learning, and large language models. I did a recent video on Snowflake, so if you want to hear more about that, please definitely check out that video after this. Next up is UPS. This is another somewhat boring company, but what initially attracted me to UPS was a couple things. One, they have a very strong track record of dividend growth, and two, they're a play on e-commerce as well. With e-commerce comes the need to ship things, and I believe that UPS is the shipper with the strongest moat, and they also happen to be trading at basically a 52-week low, if you can see from the stock chart at the top. UPS has a really strong fleet, and they just gave guidance for the next few years that actually impressed me, but then the stock got sent down. So I saw that as an opportunity to buy the stock, and I've been holding UPS and enjoying the dividends since then. Next up is Thermo-Fisher Scientific, ticker TMO. So I struggle to understand biotech companies. It's why I don't really cover a lot of biotech on my channel. However, I still believe in the long-term potential of the biotech industry. I think making medicines and helping to cure rare diseases is really important, and I think as time goes on, those companies are going to fare really well. The problem is I don't know how to pick the best one because it's not an industry I'm very familiar with. So I went with Thermo Fisher Scientific, which is a supplier to the life sciences industry. So essentially, Thermo Fisher Scientific is a conglomerate of these 6 divisions. So Thermo Scientific, which is analytics, Applied Biosystems, which helps with genomic discoveries, Invitrogen, which is discovery research, and so on. Essentially, Thermo Fisher Scientific can supply pretty much anything you need in the drug discovery industry. So you can see chemicals at the bottom left, devices at the bottom right. What I really like is that Thermo Fisher's revenues mostly stem from services and consumables, so things that are recurring year over year. That's going to help with the revenue growth, and they are geographically diversified, with only about half their revenue coming from North America, the rest coming from the rest of the world. So to me, Thermo-Fisher Scientific is a huge player in the life sciences industry and should stand to benefit no matter which drug maker is making the blockbuster drug of the day. Xylem is my next largest holding. The ticker is XYL, and this I'm holding because it's a play on water technology. I believe as time goes on, potable clean water is only going to become more and more scarce, and I believe that companies like Xylem are going to benefit. Essentially what Xylem does is help companies manage water in whatever way, shape, and form they need, whether that's transportation, whether that's purification, whether that's measurement, control, monitoring. Xylem does it all. They recently acquired a company called Evoqua, which offers these smart water solutions, Water One Services, a digital water management platform, which I believe will continue to help their margins because software does tend to have really nice margins. And we can see that the revenues are quite well diversified, with no revenue stream making up more than 30% of their total revenue. They break this down between water infrastructure, water solutions and services, measurement and control solutions, and applied water. So as time goes on, and I believe water becomes more scarce, companies like Xylem are going to flourish, I think, because they're going to help people transport water more efficiently, keep track of their water, find out where it goes, clean their water, remove salt from the water. So desalination is something that they offer products for. So Xylem, I believe, is just a giant in the water industry. They're one of the largest water companies in the world, and I'm just quite bullish on that theme. And I happen to like Xylem and their financials. They are growing slowly but surely. They pay a nice dividend. So for me, Xylem is just kind of a no-brainer stock if you want exposure to that water theme. Next up is Salesforce, and I've talked about Salesforce in another video as well, so I won't go too in depth, but one thing I will say is that this company is a free cash flow generating machine. We can see that their free cash flows have just been rising at an insane rate lately, and cash is king, according to Warren Buffett, right? So the more cash that a company makes, the more that they can reinvest in the business, they can advertise and grow their market share, and Salesforce is just a software giant, sort of like ServiceNow. They kind of operate in a different niche. They started as a CRM platform, which is customer relationship management, but they've since acquired all these other bolt-on acquisitions. You can see in this little graph at the top with the smiling girl, all of the different niches that they have. But at a very surface level, Salesforce helps a business track and grow their sales and monitor their relationships with their customers. I really like Salesforce's execution. I think they went off track a little bit. I didn't like their acquisition of Slack and some other dubious management decisions that have happened over time. I talked a bit about this in my last video on Salesforce, but it seems like they've been getting things back on track. There was a rumor that they were going to make another expensive acquisition, but they dismissed it and I haven't heard anything since. So it sounds like Salesforce is really focused on continuing to generate that amazing free cash flow and profitability that they've been doing lately, and they are still growing slowly but surely. I think as time goes on, cloud-based software is just going to be a huge winner. So I really am happy to hold Salesforce, ticker CRM. Next up is Walt Disney. This is another controversial stock. I won't get into the politics of Disney because there's a lot of that going on too. What I really like about Disney is I think they have a massive moat and they have so much amazing intellectual property. So at the bottom left, we see Mickey and Minnie Mouse that are just iconic, especially if you're from the US, you know Mickey Mouse. And I believe that that intellectual property is really going to help them in the future. They can monetize that. They continue to make movies. And what I like to see here in this chart in the middle is that even though their linear networks have gone down, that's things like the Disney Channel or movie theaters, even though sales have been going down there, they've been making up for it in the direct-to-consumer division, which is things like Disney Plus. And actually, Disney Plus just became profitable for the first time in the previous quarter, which I think is really nice to see. This article says it's a positive sign for streaming TV. It's really nice to me to get exposure to a lot of different things with Disney. You get kind of the consumer aspect with their parks. I mean, as people get more and more money, oh, let's take a trip to Disney World. So it's a nice play on the consumer discretionary sector, but it's also play on streaming and on traditional theater movies. Additionally, I believe that their valuation is quite low. If you look at PE, it seems a bit high only because their profitability has been sort of dampened lately. But I believe that that's going to recover, and on a price to sales level, they are quite cheap, and that PE is going to continue to go down. I also like that they recently reinstated their dividend. They got rid of their dividend, I think, in 2020, which I felt like was kind of a strange move, but it's nice that it's back. Next up is Applied Materials, ticker AMAT. Essentially, Applied Materials is to the semiconductor industry what Thermo-Fisher is to the life sciences industry. So Applied Materials sells everything that's needed to manufacture semiconductors. Maybe not everything, but they do have the broadest portfolio of semiconductor equipment out there on the market. They're a bit of a growth and value stock, so they do pay a dividend, which has been rising over time, as you can see from that chart on the top. what I liked about Applied Materials as opposed to other semiconductor equipment companies like maybe ASML is that Applied Materials, I think their business is going to be a lot more steady, whereas ASML is going to see boom and bust cycles. So right now they're seeing a bust cycle, but they're expecting 2025 to be a great year. I don't really like the uncertainty of having a big negative revenue growth followed by a big positive revenue growth. I'd rather take the slow and steady approach that Applied Materials has because of their broad portfolio. So whether we're in the bull cycle for EV semiconductors or advanced computing semiconductors, Applied Materials is going to make the equipment that you need for any type of semiconductor, essentially. So I like the stability and the semiconductor exposure that Applied Materials gives, and it operates a core position in my portfolio, being a bit of growth and a bit of value. I really like this stock. Next up is Palo Alto Networks, ticker PANW. This is a cybersecurity company. They started off specializing in firewalls, but they've kind of advanced that, so now they have kind of a hardware and software-based company. Essentially, Palo Alto Networks is a really well-diversified cybersecurity company. They offer network security, endpoint security, which is just securing end devices like a cell phone or a laptop or a company computer, and cloud security. They also offer data security, which I didn't see on this list, so I think Palo Alto Networks is just a no-brainer if you're trying to pick only one stock, which I was doing. I didn't want to hold a whole bunch of different ones because you could argue that CrowdStrike is the leader in endpoint and then Zscaler is the leader in zero trust. But why not just buy one company, in my opinion, that gets you exposure to all of those themes? So I do have another cybersecurity company that I'll talk about later, but it's not exactly a pure cybersecurity company. And so Palo Alto Networks is kind of my cybersecurity exposure. I thought I'd take the all-in-one approach and go with this leader, in my opinion. Their financials are very strong. They're growing very well. They have strong profitability. They have great margins. I just really happen to like Palo Alto Networks. The price is a bit high, but when you look at companies like CrowdStrike, I know CrowdStrike's growing a lot faster, but CrowdStrike has double the valuation that Palo Alto Networks has on a price to sales level. And I mean, I just don't think that much is warranted. I think Palo Alto Networks, when you compare it to some other cybersecurity players, looks a bit more reasonable in terms of valuation. Next up is Shopify, ticker SHOP. Shopify is another play on e-commerce as well as in-person sales. You can see that they also have a point of sale system at the top there. Shopify has just been a revenue growth machine. They have been growing revenues steadily over time, and their revenue growth is still above 20% in the recent quarter, which I love to see. They're becoming leaner. They sort of offloaded their logistics division, so essentially they're becoming more and more of just a pure software/platform company. And what I like is that they also offer exposure to the rise of digital creators. Most digital creators use Shopify or a similar platform to sell their merch, their products, their digital products. So I really like Shopify as a play on e-commerce and as a play on the gig economy. I really love that they've been growing really steadily. I talked about Shopify in a recent video as well, so if you want more, just you can watch that as well. Next up is Adobe, and Adobe used to be higher on my list, but I recently trimmed some after the stock began to rally. The reason I'm not quite as bullish on Adobe anymore is for a couple things. There's been a bit of controversy about them making it very difficult to cancel their customers' contracts. So if you're an Adobe customer and you go to cancel your contract early, a lot of times they make you pay a fee, which I don't know. I get that that is going to help their profitability, but it's also a bit slimy, and I need to make sure that that doesn't damage their brand reputation. Also, they haven't really monetized their Firefly generative AI platform, and I really thought that that was going to be a big sales driver, and I think it is, but I really need to see that come to fruition in the future. Another thing is that I'm also kind of looking into the environmental and energy impacts of generative AI. I think there's a lot of people who are against generative AI because of the environmental impacts, and I need to look into that and make sure that that is valid, because that could really put a damper on the demand for generative AI going forward. So Adobe, I am cautiously optimistic on. What I love is that they just have really strong execution in their revenue growth. The revenue growth has been growing steadily. Their valuation for a software company makes a lot of sense. I think it's something like 12 to 15 times annualized sales. They have amazing gross margins, something around 90%, and they just have a really wide moat. I mean, you think about PDFs, pretty much every workplace is going to buy Adobe so that you can edit and manage PDFs, but also for creators that use things like Photoshop, Adobe has a lot of solutions that are really well ingrained in the world. Next up is Clean Harbors. Clean Harbors is one of my favorite stocks. It's actually one of my best performing stocks too. I don't know why this stock has done so well, but here we are. Clean Harbors ticker is CLH. Essentially, they are a waste management company. What they specialize in is hazardous waste disposal. They also have divisions in emergency response. So if a community is hit by a natural disaster, Clean Harbors can come out and help with that. They help out with recycling of oil. so oil collection, re-refining, as well as things like environmental services. So as their name implies, they help clean up the oceans. I really like to see that a company can help the environment while still making a profit. I think that's really nice. And I really wanted to get exposure to the sustainability theme. I think sustainability is huge, and I think it's going to be a big investing trend in the next few decades. We only have one Earth, and companies that help take care of it while still making money, I think will stand to benefit. So that's what I really like about Clean Harbors. As we can see, their free cash flow has been on the rise. They have adjusted EBITDA of more than $1 billion per year. They've had that for 2 years in a row, which is really nice. As a somewhat smaller company, I think their market cap's around 10 to 12 billion. So their valuation kind of makes sense here, even though their stock has just been on a tear lately. And I think as time goes on, we may see more and more natural disasters as the environment begins to worsen. So Clean Harbors stands to benefit from that, unfortunately. Also, I like that they've carved out their own niche in waste management. It's not just a trash collection service, it's hazardous waste disposal, which requires a bit more specialized training. And I think that gives Clean Harbors a bit of a moat. Next up is Intuitive Surgical, ticker ISRG. I've always thought that this stock was so expensive, so I kind of slowly got into it, and it's just been going up even more. So I still think Intuitive is expensive, but I think it's a really solid company, and I'd rather own a wonderful company at a fair price than a fair company at a wonderful price kind of thing. So I don't think the price is wonderful for Intuitive. I think it's quite high, but I'm not selling because I really do believe in this company long term. Essentially what they make are these robotic surgery devices. So as on the left, this is their Da Vinci system, and it's kind of the gold standard in robotic surgery. The chart on the bottom here shows the number of Da Vinci procedures each year. We can see that's growing really rapidly as of 2021. And the compound annual growth rate for robotic assisted surgery is expected to be something like 13% over the next decade. So robotic assisted surgery, in my research, has been shown to be a lot more successful, and I think that's what has helped it become such a no-brainer for hospitals to adopt. So I think as time goes on and Da Vinci becomes more and more popular, I think that's going to help ease people's minds who might be a little bit nervous about robot-assisted surgery. And I think as time goes on and people see how successful that is, companies like Intuitive and Procept Biorobotics, I think is the other one that does this type of thing. I think those type of companies will continue to prosper. Intuitive just has an amazing balance sheet. They have, I think, something like $7 billion in cash, then they're just not doing anything with it. They're just kind of sitting on it, which is interesting. They have really strong profits and revenue growth. And even though the valuation is a bit high, I just think this is a wonderful company, and I think they're going to continue to eat up all the market share. They're just going to be a huge leader in robotic assisted surgery for the near future. Next up is Arista Networks. This is another one that I've been trimming lately. I think the valuation's been getting a bit out of hand, but I am still bullish on the company as a whole. Essentially, Arista Networks specializes in Ethernet switches. That's this box that you can see on the left where Ethernet cables plug into. They're used a lot in data centers to help the computers talk to each other. And essentially, Arista is kind of displacing companies like Cisco, where they just haven't innovated as much, whereas Arista has done a really good job of innovating. And we can see that they're expecting continued growth from data center demand, as well as the growth in cloud computing and other exciting disruptive themes. So Arista helps these computers in a data center talk to each other, and their two biggest customers are Microsoft and Meta, both of which are investing heavily in AI. So I think that's going to be a nice revenue stream for Arista going forward. I really like to see a company that benefits from the growth of AI and data centers. And by investing in Arista, I'm kind of taking a bet on both Microsoft and Meta without actually owning the stocks, because I'm not terribly bullish on Meta's advertising business, but I am bullish on their Llama large language model. So by owning Arista, I can get exposure to that AI division without the advertising division. Next up is Cloudflare. This is the other cybersecurity company that I was talking about earlier. Their ticker is NET, which is kind of clever. And essentially, Cloudflare specializes in a couple things: edge computing and cybersecurity. So edge computing, we can see on the left, essentially what it is moving workloads closer to the end user to improve performance and speed. And on the right, we can see that they also offer cybersecurity solutions. So they've recently moved into the zero trust security market, as well as the network connectivity market. What they really specialize in is preventing DDoS attacks, which is designated denial of service, essentially where someone overwhelms your website in order to take it down. Malicious people do that, and then they ask for money in order to back off. Cloudflare helps prevent that. Essentially, they're like a firewall for the internet. Cloudflare, really cool company, growing insanely well. We can see that in the top left, this is a chart of their revenue over time. We can see the consensus is the dark blue, actual is the light blue, and they pretty much always beat earnings expectations. So the light blue is always higher than the consensus dark blue. So I really love to see a company that continues to beat people's expectations. And I think they have a lot of tailwinds for things like AI and cloud computing. Next up is Nintendo. Nintendo is a stock that I happen to like because, like Disney, I think they have a lot of intellectual property that they continue to monetize. And I think they're not quite doing enough with this, and I think they will going forward. I'm also quite bullish on gaming. I think as time goes on, humans are going to have more and more free time as things get more and more automated, and they're going to fill that free time with things like gaming. So Nintendo is one of the leaders in video game consoles, second only to Sony, which develops the PlayStation. They actually have a similar market share as Microsoft's Xbox. What I really like to see from Nintendo is that they are shifting to have more and more digital sales, which is going to improve their margins. And I think that's sort of where the future of gaming is headed, is digital sales. Nintendo also offers a subscription, which I think is going to lock in customers and provide them some recurring revenue. They also have a new Switch product coming out, which I'm quite excited about. So we'll have to see what that does for their revenues going forward. 24th, second to last, is STMicro. This is a company that develops semiconductors. And they specialize in SiC, which is silicon carbide, and most of their business currently comes from automotive. So they sell SiC chips to companies like Tesla and BYD to use in electric vehicles. However, they have such a broad range of semiconductor products that they have a lot of applications. So things like industrial automation, data centers, clean energy. STMicro sells products for all of those different niches. So even though there's a lot of weakness right now in automotive, ST is still able to sell their solutions to other industries, which I think helps them in turbulent times. So I am quite bullish on electric vehicles, and that's why I wanted exposure to the SiC chip thesis, because SiC chips are used primarily in electric vehicles right now. They help to improve driving range and energy efficiency in electric vehicles, so they're kind of a no-brainer. Even though Tesla has recently decided to use fewer SiC chips, they are still using SiC, and I think as the economy recovers and the electric vehicle industry also recovers, STMicro should stand to benefit. But even if the electric vehicle market doesn't ever really make a huge recovery, they also have markets like industrial automation, which tend to be pretty evergreen that they can sell to. They happen to have a pretty low valuation on both the price to sales and price to earnings level. So even though their financials right now don't look so great because of the downturn in their business, I think over the long term this should recover and people will likely buy into this company seeing their low valuation. Finally is Trex. This is a newer ad, that's why it's at the bottom of my list. Trex makes composite decking. So not the most exciting company, but I happen to really like this company, again, from a sustainability perspective. They're one of the largest polyethylene film recyclers in North America, so they help recycle plastics and turn it into this beautiful decking, which is more resilient and doesn't wear out as quickly as traditional wood products. Their deck products are made with 95% recycled materials, which I think is great. As time goes on, companies that are sustainable, I think, are really going to stand to benefit, and they have a really big market opportunity, surprisingly. So they claim that they've only captured 12% of their market share, and they're slowly integrating into the residential, outdoor living, commercial, all these different segments that they believe will help them to continue to grow their market. What I like about Trex is that even though they do kind of have boom and bust cycles, they have been steadily growing over time. They hit a bit of a snag in 2021 and 2022, but that's only because they saw so much demand in 2020. So if you kind of zoom out and take out the outliers, we can see that Trex is still growing really nicely. And for a company that sells decking, they have really nice margins. These are premium products, so people do pay a premium. So it's kind of nice that they're able to, like I said with Clean Harbors, make money while helping out the earth. All right, so that was my portfolio. I hope that this gave you some insights. I know a lot of people have been asking to see my full portfolio. I do offer a YouTube membership, so if you want to see the trades that I'm making in real time, I post them for my members. It's, I think, $1.99 a month. So if you'd like to join, there's a join button down below. That's one way you can support me and my channel. But otherwise, don't feel obligated to do that. Please just, if you liked the video, hit the like button. If you disliked it, hit the dislike. Tell me what I can do to improve. And thanks for sticking around. I know this was a really long video. If you have any stocks you'd like me to cover, please leave them down below. Please subscribe if you're new. I think that's all the things. Thank you guys so much for watching, and I hope you all have an amazing day and weekend.